Tyco International, the $600 million heist by a rogue CEO. Tyco International's story is one of corporate governance failure, blatant greed, and ultimately, criminal deception. Imagine waking up one morning to find that a company you've trusted has been orchestrating a massive financial fraud led by its own chief executive officer. This is not just a tale of misplaced trust. It's a cautionary lesson about the vulnerabilities in corporate oversight that can lead to staggering losses, both for shareholders and employees alike. To understand how Tyco International came to epitomize the heights and pitfalls of corporate America, we must first delve into its origins and growth. Established in 1960 by Arthur J. Rosenberg, Tyco originally operated in the fire protection industry before diversifying into various sectors, including healthcare and telecommunications. By the late 1990s, Tyco had positioned itself as a massive player in global business, with revenues exceeding $40 billion and a market capitalization of around $100 billion at its peak in the early 2000s. Now, enter Dennis Kozlowski, who would become synonymous with Tyco's downfall. Appointed CEO in 1992, Kozlowski was a charismatic leader known for his significant role in transforming Tyco through extensive acquisitions. Under his leadership, the company expanded aggressively, acquiring more than 600 firms. By 2000, in the midst of the tech boom, Tyco appeared invincible. It was viewed as a company on the cutting edge, adapting and thriving in a rapidly changing economic environment. But appearances can be deceptive, especially in corporate structures that conceal the reality from their stakeholders. And that reality was a staggering misappropriation of funds. Over $600 million were siphoned from the company in various forms. How did this happen? At its core, Kozlowski exploited a feeble oversight system. This brings us to the mechanisms of corporate governance, or the lack thereof in Tyco's case. In theory, corporate governance is designed to protect shareholders, ensuring that a company's leaders act in the best interests of those who invest their money. It is meant to establish checks and balances, preventing executive power from going unchecked. But Tyco's board failed in its role, creating a culture ripe for abuse. Managers and executives were incentivized to outperform benchmarks without close scrutiny. This detached oversight allowed Kozlowski to operate with impunity. Kozlowski did not stop at mere compensation. He devised extravagant plans for personal gain. For instance, he had a personal art collection funded by company money, extravagant perks like private jets, and even a lavish birthday party in Sardinia, where the cost soared to $2 million, all funded at the expense of Tyco International. In total, these lavish expenditures exemplified Kozlowski's belief that he was above the confines of normal corporate ethics, and the sycophants surrounding him certainly enabled this mindset. A glaring example of Kozlowski's manipulation came to light through a series of undisclosed loans that totaled in the hundreds of millions. He used these loans for personal expenses while representing these amounts in company financial statements as liabilities, thus concealing them from shareholders. The loan structure was particularly pernicious. They were initially framed as cash advances or bonuses, conveniently obscuring the true nature of the financial transactions. Then there's the issue of the opaque financial reporting that characterized Tyco during Kozlowski's tenure. The Internal Revenue Service and the Securities and Exchange Commission generally require transparency to prevent fraud. For most companies, financial statements undergo rigorous audits to ensure accuracy and compliance. Tyco's financial disclosures, however, were often poorly communicated and facilitated an environment where misrepresentation could thrive. In July 2002, financial analysts began to uncover discrepancies in Tyco's accounting practices. The situation escalated dramatically when Tyco announced that it would be restating its financial results for the prior 3 years, an action taken to correct inflated earnings that had misled investors. This revelation sent shockwaves through Wall Street, and Tyco's stock price plummeted from a high of around $60 per share in early 2002 to less than $20 within months. As the scandal unfolded, the wider implications grew more apparent. Employees faced layoffs and drastic changes, cutting thousands of jobs as Tyco scrambled to recover from the financial fallout. The ramifications reached into the lives of shareholders, with billions in market value evaporating almost overnight. Moreover, confidence in corporate governance eroded considerably, resulting in calls for stricter regulations and oversight of corporate practices. The legal consequences that followed were equally historic. In 2002, rumors circulated that Kozlowski's lavish spending and the fraudulent financial practices would soon come to light. He and the former chief financial officer, Mark Schwartz, were arrested in 2002. Thereafter, they faced multiple charges, including grand larceny and conspiracy. Subsequent investigations unveiled a depth of corruption and deceit that surprised even seasoned regulators. Prosecutors estimated that Kozlowski stole about $600 million, not just through outright theft, but also via elaborate financial schemes designed to mislead board members and investors. During the trial, the evidence was damning. Surveillance footage from lavish parties that featured extravagant gifts and even a $6,000 statue carved from marble turned public sentiment against Kozlowski. While the lavishness of his lifestyle had initially seemed harmless, it ultimately manifested into skepticism regarding Tyco's equilibrium and management culture. In 2005, after a highly publicized trial, Kozlowski was convicted on multiple counts, including grand larceny, conspiracy, and fraud, and received a prison sentence of 8 to 25 years. Schwartz received a similar sentence. The consequences of Tyco's mismanagement would resonate beyond individual stories. They would eventually play a pivotal role in the enactment of the Sarbanes-Oxley Act of 2002. This legislation was crucial in shaping corporate accountability in the United States, establishing stricter regulations for financial disclosures and ensuring closer scrutiny of company audits. The law imposed severe penalties for corporate fraud and instituted measures that would require public companies to enhance the accuracy of their financial reporting. While Tyco was undergoing its public reckoning, many anticipated that the event would lead to a definitive cultural shift regarding corporate ethics. However, the incident prompted more than just regulatory changes. It raised questions about the entire framework of corporate America and its ecosystem. Shareholders voiced their concerns regarding the accountability of CEOs and board members, stressing that a shift was necessary to ensure that they were not merely figureheads, but participatory in safeguard mechanisms. With the fallout from the scandal providing a window into deeper systemic problems, it became essential for investors and regulators to grasp the need for a balanced and diversified board, auditors free from conflicts of interest, and an internal culture focused on accountability at every level. Fast forward to today, and the lessons learned from the Tyco International debacle remain critical to understanding corporate governance. The Tyco scandal is not merely an isolated incident, but a vital chapter in ongoing discussions around corporate ethics and accountability. Virtually every corporate entity today adopts the best practices shaped by the aftermath of Tyco's failures. Issues such as diversity on boards, the role of institutional investors, and the need for transparency have become focal points for discussion among regulators. Moreover, the landscape of executive compensation has shifted dramatically, with companies employing performance-based metrics in a bid to align the interests of management and shareholders. The modern business environment is shaped by challenges that demand greater accountability and clearer oversight structures, ensuring that what transpired at Tyco cannot be easily replicated. As corporate fraud continues to capture headlines, the Tyco saga serves as a potent reminder, as relevant in the current climate of high-stakes finance as when it first unfolded, of the fragility of both public trust and corporate integrity. It begs the question, what further protections must we enact to ensure that we never again witness such an egregious betrayal of trust? In reflecting on Tyco International, we realize that uncovering corruption is just as significant as ensuring strong governance structures in corporate entities. The real impact extends far beyond boardrooms and financial statements. It interlaces into the livelihoods of countless employees, investors, and their families. And as we navigate the complex waters of global finance today, we must hold tightly to the lessons drawn from Tyco's rise and eventual fall, a narrative that continues to shape corporate ethics and governance standards. As stakeholders in the financial system, Acknowledging these lessons can help build a more resilient, transparent, and accountable future for corporate America and beyond. If you found this story interesting, hit that like button and subscribe so we can keep making these videos. Tomorrow, we are diving into a story that is just as shocking. Carlos Ghosn, the fugitive CEO who escaped Japan in a box. You will not want to miss it. I will see you there.